As mentioned, I'm Josh Felix, Senior Energy Analyst at Palmer Energy Company. Joe mentioned Palmer Energy is the authorized energy consultant for the Growers Energy Solutions Group. We partnered with GES for quite some time, and we certainly value our longstanding relationship and hope it continues long into the future. We thank you for the opportunity to present today. If anyone has any questions, Joe mentioned it, please feel free to stop me as I'm rambling on. The topic here today, it's not really a secret that natural gas prices, commodities prices as a whole, have been climbing in recent months. Consumer costs are up across the board with inflation rising, and at the same time, taxes are rising as well, all of which leads to higher wellhead break-even costs for energy producers, and that's ultimately borne out by you, the end user, in your utility costs. So we'll peel back the layers on what's been going on in the market recently. Before that piece, a quick review of the different components that make up your natural gas bill. Larger end users are generally labeled as GTS users or general transportation service. Smaller to mid-sized users are generally labeled as choice users. For all users, the deregulated side of the bill, which is comprised of two different components: the commodity portion, the cost of the physical gas itself, which trades by the second on the wholesale New York Mercantile Exchange, or NYMEX for short, open wholesale market. And then the basis cost, which in its easiest explanation is the transportation cost to get the gas from the producer wellhead source to your local utility. Then you have the regulated portion of your bill. These are both fixed rate and variable costs that are assessed by your local utility. In Ohio, these utilities are Columbia Gas of Ohio, Dominion Energy Ohio, CenterPoint Energy, which was formerly Vectren Energy, and Duke Energy Ohio. And these distribution rates, they're regulated and approved by the Public Utilities Commission of Ohio. They can't really be negotiated. There's a little bit of wiggle room on moving between the different tariff rate codes. But again, that's your regulated side, whereas the commodity and basis portions, as I mentioned, on the deregulated side, these can be negotiated with third-party suppliers, and that's part of what Growers Energy Solutions helps its participants negotiate for. What drives market prices, and we'll get into this in the next few slides, but there are a myriad of factors. These are your main headline grabbers, so to speak. Weather will always reign supreme at the end of the day. When you have warmer winters as a whole, this will inevitably induce pricing to the downside due to falling demand, and then vice versa. You have colder winters or hot summers, that's going to induce market upside. But many other factors play a key role as well that are influenced and then are a little bit inelastic to weather, storage, production, imports and exports, et cetera. Shale gas, and discussing the shale gas revolution over the past decade, we're referring to non-basin areas in the United States where natural gas is available via underground drilling rigs. Bringing more accessible gas to the market combats the variability and unpredictable nature associated with those shifts in the weather. As I mentioned, the natural gas market and in turn the electric market will always be primarily driven by changes in these weather forecasts, and that concept isn't going to go away. But these commodities prices are now arguably less of a quote-unquote prisoner to ever-changing weather forecasts than they were in the past, due to the additional production now available via onshore plays, shale plays, much of which are right in our backyard in Ohio. You have less of that production down in the Gulf of Mexico, which was very susceptible to hurricanes and acts of God. And this is why we're seeing the gas market more comfortable trading in that $2 to $5 range relative to $12 to $14 gas back in the mid-2000s. So the Marcellus and Utica shale plays are the formations that have been booming in the Appalachian region of the country, as you see in the graphic, abound throughout West Virginia, Pennsylvania, New York, and Ohio. In 2010, less than 2% of this dry gas production came from our area of the country, and today about 40% of it comes from the Appalachian region. Increases in oil drilling in Texas, these have led to higher associated gas output levels. Natural gas comes as a byproduct of oil production. And as I mentioned, Gulf of Mexico production, it used to account for more than a quarter of domestic production in the early 2000s, and today it's only about 2 to 4% of total U.S. production, so much less susceptible to hurricanes. And the graphic does a good job of representing this. Look back to that 2009 to 2011 timeframe. You notice the very tiny green sliver for the Marcellus Shale and the virtually non-existent red Utica Shale versus where those levels are at today in the U.S. Supply stack. And then, the other major gas producing basins, these come mostly from the oil and gas rich state of Texas, Permian Basin, Haynesville Basin, Eagle Ford, and Barnett Shale down there. Quick fact, the shale formation in the North Dakota and South Dakota footprint is known as the Bakken Shale Formation. Due to the severe lack of pipeline infrastructure in that area of the U.S., they've actually had record amounts of gas been flared or simply burned off immediately after production out of the wellhead, again, because of that nowhere to ship it and no means of shipping it. So kind of a waste of a natural resource that we obviously have right at our fingertips. And now we'll get into some of the different fundamental factors that cause natural gas prices again to move higher or lower. And to explain a higher pricing environment, which we are currently in relative to years past, the first place you have to look under the hood for potential reasons why is the U.S. fundamental picture, because these factors, again, production, demand, exports and imports, et cetera, these are what historically drive prices higher or lower. Rig counts, drilling rig counts, they aren't as big of a consideration as years past due to the technology associated with horizontal drilling as opposed to vertical drilling in the past, which is much more prevalent. But it can still be useful to view the shifts over time. You can see rigs in both oil and gas have been on the upswing since the Saudi Arabia-Russian oil pricing war in early 2020, and upticks in associated gas production are projected from the recent increase in oil drilling rigs. However, you see that gas drilling rigs have leveled out recently. Energy producers, they promise to be disciplined with their drilling levels and not flood the market to capture profits after years and years of lower financial returns. And they've stuck to that promise thus far, but really time will tell how long that lasts. And it's a matter of when, not if, those production levels increase with this higher pricing environment, again, that we're currently in. Gas production peaked in late 2019 after a steady climb from the winter of 2016, 2017. You see where we used to be, around 67.5 BCF per day, all the way to its peak again around 96 to 97 BCF per day currently. And when we say BCF, this refers to billion cubic feet of gas. 1 BCF of gas generally provides annual gas heating requirements to about 10 to 12,000 households in our area of the country. And you'll see on your gas bills, typically, you'll see CCF, which is 100 cubic feet of gas, or MCF or decatherm, which is about 1,000 cubic feet of gas. But again, in the graph, you see the COVID-related drop in the summer of 2020 from 96 to 89.5 BCF per day, with not too large of a recovery thereafter, all things considered. Now we're still recovering from that time frame, obviously. Electricity generation, aka power burn, always a huge focus for electricity prices due to gas being such a prevalent fuel source for electric generation. Somewhat of the same trend here, increasing steadily from 2017 through last summer before it dipped starting this past winter. Higher gas prices lead to more fuel switching from gas to coal for those large users who have this accessibility. However, what we're seeing is that gas to coal switching is not as price elastic as it was 5 to 10 years ago, despite the market's best efforts over the past summer and fall in raising these NYMEX gas prices in hopes of taking material amounts of demand out of the equation and shifting it over to coal. Again, it's just not happening at the level that it has in the past. In the past, coal fuel sources were more widely available than they are today due to EPA regulations and plant retirements. And even when factoring in renewable energy's growing share of the pie, gas demand hasn't been curbed with the economic recovery as many people would have expected like it has in the past. The big player in the supply and demand fold is the robust export market. The United States was always a net importer of natural gas up until 2017. That's certainly spun on its axis, and exports are now outpacing imports of gas by close to 13 to 14 BCF per day, which is a monumentally huge swing. And the U.S. is actually now the largest exporter of natural gas in the world, slightly edging out Qatar and Australia as of the last few days in 2021. LNG, liquefied natural gas, the orange line in the graph, gas that is cooled to negative 262 degrees Fahrenheit to decompress its size. LNG gets all the necessary publicity, and for good reason. But pipeline exports to Mexico, the blue line in the graph, have also steadily increased as Mexico has not implemented longer-term plans for gas supply and storage infrastructure. So effectively, they've been willing to pay any premiums of which U.S. producers are happy to oblige them on to make a few extra bucks as opposed to supplying domestically. Again, all told, you see the recovery for the many canceled LNG cargo shipments in the summer of 2020 due to COVID lockdowns. LNG demand was up about 5.5 billion cubic feet per day since last summer's average. And any future growth will be dependent on final investment decisions for future LNG terminals. And these are multi-billion-dollar decisions from investors, and none of these are imminent in the interim, with the exception of one terminal that's coming online here in the next month or so. A little bit of a closer look at the LNG liquefied natural gas demand stack, with the different colors representing the various LNG terminals currently in operation throughout the United States, most of which are down in the Gulf of Mexico, with the exception being the Cove Point terminal running out of Maryland on the East Coast. You see a little wiggle room for further demand growth this winter and heading into next spring, close to 1.5 BCF per day coming online, again, from the operational startup of that new LNG terminal, which is the Calcasieu Pass. But the headlines in the news you've probably seen in recent weeks and months regarding this potential LNG demand growth and for the current winter, stating that the U.S. will need to start pumping crazy amounts of gas volumes overseas to aid in the quote-unquote energy crisis that's going on in Europe and Asia. What they're missing is it's simply not feasible to pump whatever you want to. You have to have the infrastructure in place, and we're already running at max capacity. So again, those news headlines were a little bit misleading. We're already running at close to max capacity for gas exports that we can for the current winter. That's going to increase over time as new LNG terminals certainly come into the fold. But again, for the current winter, a little bit over exaggerated with the current quote unquote dire situation that the United States was in, having to supply on a global scale as opposed to when we had it in the past. Ultimately, we arrived at the current U.S. gas storage situation, which looks much better than it did a few months ago due to the weather cooperating in the fall and the early winter. And we came into the winter at about a 2% downtick storage-wise versus the 5-year average. The 5-year average being the gray dotted line here, and the blue line being where actual storage is at. And then you see the maximum levels that are highlighted in gray, and then the minimum highlighted in gray at the bottom. We're currently, again, at about a 2% storage surplus versus the 5-year average. So a quick recap: other than gas exports jumping off the page in recent months, nothing really looks all that dire from a fundamental perspective, and storage is in a more than comfortable position. So the popular question then is, why did winter gas prices peak at 13-year highs late last year, around $6.50 per unit, when we've comfortably been trading the $2 to $4 range prior to this period? And the conclusion that we've come to, given what we know now, is that the current market, gas industry, is almost completely, if not all the way, detached from the fundamental factors that historically dictate these NYMEX gas prices. And it's a perplexing market. You're seeing speculators jumping in much more readily to buy prices higher than they are to move them lower. And what we're looking at as the market's impetus to move higher is lower storage levels abroad and higher global gas prices, allowing for the domestic price of natural gas, i.e. NYMEX and Henry Hub, to move higher in correlation. And note this graphic on the screen right now. It's a few months old, but the message largely remains the same. You can look at the significant gap between the blue Henry Hub line, which is the U.S. baseline price of natural gas trading down in Louisiana, versus the green Asian LNG line, the red European LNG line, and the yellow British LNG line. Anywhere from, anywhere from $25 to $30 worth of profits for U.S. producers by shipping this gas overseas. And LNG terminals, again, are churning out as much gas as possible to capture these margins. And the graph doesn't even display the premiums available by shipping gas to Mexico via pipeline. Again, the U.S. gas market has historically been mostly detached from the global markets, but now being the largest exporter in the world, that just hasn't been the case in recent months. This is the reason U.S. gas futures Again, this is the reason U.S. gas futures have been able to move this high, this quickly, despite fundamentals that do not appear so dire. It really puts into perspective the pricing situation the U.S. is in for commodities relative to the rest of the world. Again, anywhere from $2 to $6 gas versus $30 to $35 gas abroad. On the current screen here, the same sentiment is depicted. NYMEX Henry Hub prices in dark blue. These correlate to the prices listed on the right-hand y-axis. The global LNG gas prices, red, green, and light blue, they correlate to the prices listed on the left-hand y-axis. $3 to $6 largely for U.S. gas versus $15 to $40 for gas abroad. The pricing baselines, they don't move in perfect harmony, but they're pretty darn similar and by no means can be considered as a coincidence at this point. So here, and I figured this would be everyone's main focus on where prices are at now versus where they're going in the future versus where they were at in the past. The slide, it shows historical NYMEX gas supply prices versus, again, where those future prices are trading at in the 2022 to 2025 timeframe. What these do, these prices reflect a weighted average annual price for the months of November through October for a typical heating load customer, one that uses about 90% or so of its annual gas heating requirements between the months of November through April. Obviously, as growers, the majority of your load is going to come in that February through April or May timeframe, but by and large, these price estimations on the screen will still hold pretty steady when incorporating your various load patterns. If you look to future prices on the right-hand side, again, we've calmed immensely from the market peak in October when these winter prices were trading at about $6.50 for the current winter. We're down to slightly under the $4.50 window right now. Looking out to next winter largely right around the $4 level and then back down into the $3.50 level for the 2 years after. So not where we were at over the past 7 years. Again, and we're in a different pricing environment now, but it puts into perspective where we used to be at not all that long ago versus where prices are at today. So they're higher than the past 5 to 7 years, still much, materially lower than we were in the mid to late 2000s. And here's just a quick review of the Growers Energy Solutions natural gas program. I'll just take a quick 15, 20-second pause here. Rather than be redundant and read everything on the screen, I'll let everyone read the various facts of the program. And same thing here, I'll pause for really quickly. These are the services, various services provided by the Growers Energy Solutions program.
So Palmer's really been with us now 12 to 15 years and done a really good job guiding us through this volatility. When there's a chance here, Josh, can you talk about which growers geographically we could sign up in the future? Because I know we've reached out to all of Ohio and from time to time on and off into Michigan. We also work with Ohio Gas and we work with the others. There is a little bit of a restriction with Ohio Gas as to who can jump on board based on their volumes. But those growers that we have on the Zoom call that may not be with the program, is there still a chance they could sign on, and how might that occur?
Right. Yeah. The majority of your opportunity is going to come if in Ohio you're in one of the major utilities. So again, if you are receiving distribution services from Columbia Gas of Ohio, Dominion Energy Ohio, CenterPoint, which again was formerly Vectren, or Duke Energy Ohio, that's going to be, if you're in one of those four utility footprints, there's very likely that we'll be able to find some competitive rates via third-party supply for you. And then you had mentioned Michigan, though that program mostly is back to full utility supply right now. And Michigan's a little bit of a different animal due to the way that the utility buys gas and then resells it. They differ than Ohio's structure. So there's more opportunity right now in Ohio. But if gas prices continue to calm in the next couple months and years, then I think that there will be opportunities again for those users in Michigan.
Real quick, we can also, this is Ann with Palmer, we can also look to help in Pennsylvania within the next couple of weeks, Illinois, if there's any connections there. And we also are licensed in Indiana. So there's a bigger footprint, but we have historically focused on Ohio and Michigan.
So we'll wrap up with a couple more slides here. Again, Palmer Energy and the Growers Energy Solutions Board. Over the years, we've employed a variable hedging strategy for the gas participants in the program, in which future gas volumes are locked in, partial future gas volumes are locked in at a set price. And so that no matter how the market moves, a portion of that future load has a set fixed price. So for the current winter, you can see the GTS group's hedges for the growers compare extremely favorably with where the market is trading at today. We had 30% of gas volumes hedged and locked in for the past November and December. We had 50% locked in for this January and May. And we had 60% locked in for the February through April months based on different opportunities that had arisen over the past few calendar years in the market. And current hedges, you can see at the bottom for this winter and spring, are below the current market by close to $150,000 for those hedge volumes. And I believe that the initial hedges for this winter, they were laid in probably some 2.5 to 3 years ago. So we take that longer term buying strategy again to mitigate some of that risk and then guarantee that your gas is going to be delivered at a very competitive price. A price that, again, if you have a warm winter, might be slightly above market, but if you can take some of that risk out of your utility cost portfolio, it's hard to complain with $2 and $3 gas at the end of the day. And then the same thing here for next winter and spring in 2022, 2023. We currently have 30% of anticipated gas usage locked in at very competitive levels, around $115,000 to $120,000 below where the current market is trading. And we'll be looking to get heavier on those hedges over the coming months as worthwhile opportunities hopefully present themselves in the market. And with that, I'm happy to address any questions anyone might have. And if not, here is Palmer Energy's contact information.
Yeah, and if there's anyone on the call, I see Jeff on the call in the Ohio Gas service area. We do things a little different there because of the limitations on the number of suppliers we can work with. And we do put a fixed price in place. And this year's price, obviously, well under market as well. So it's a good strategy to put that protection in place, at least for partial hedge, if not, or at least take advantage of which service area helps us, gives us the opportunities. I'll let Josh take any questions now.
Everyone's so talkative. Yes, if anyone has here a question in the next couple of minutes, just unmute yourself regarding our gas. Maybe Ann, you can comment. We also offer an electric program too, to save on electric rates. What's the status on that? Because it's kind of different.
It's the same, basically the same setup. We're able to help in any, with your electric savings as well. We typically do fixed pricing for electric just because it's a much more volatile market. And really you can do anything from, some of your smaller accounts clear through those growers that use indoor lighting for growing. But just a matter of taking a look at your invoices and seeing, what you're currently doing and if we can help you. But just reach out. We're available to review anyone's accounts that is interested.
Now, that would be true in most locations other than municipals. Is that correct?
Correct. Any of the investor-owned utilities. So First
Yes.
Energy, AEP, yeah. But not in any of the rural communities or the co-ops.
Yeah, the munis. Okay.
Yeah. Josh's timing was good there. I think you gave us 30 minutes, so
Go.
4 minutes to spare.
Well, he's been practicing all week, I'm sure, with other people on the phone. So he's got the lingo down. No question.
Yeah.
Well, I want to thank our Palmer representatives for coming on board here this morning and explaining the micro and macro nuances with natural gas here worldwide and with ourselves. Anyone that would like to, that have not yet looked into our program, give me a call, give me an email, whatever, and we'll get you into the right spot. I know Palmer had their contact information listed, but if you didn't have a pen handy, it's kind of hard. You can get a hold of me and I'll just pass you on.